Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka. Well, Friday cheer. Finally, some green on the screen after 4 straight days of losses. And of course, the markets are taking it up with both hands. 150-point move on the Nifty. In fact, came very close to reclaiming that 26,000 mark. Didn't quite get there. But 25,993, that was the swing high that the Nifty made today. Nothing really to complain, today at least, because, today's move has helped the index trim some of its weekly loss. As I mentioned, Monday to Thursday, we saw, deep red on the street. Yesterday, of course, we did, manage to close above that 25,800 mark, and we recouped some of those intraday losses. Of course, we were trading in the green territory as well for some time, but we ended in the red. But today, from the word get-go, we have been on the gaining end, and that's good news. 150-point up move on the Nifty. Mid-cap index, there's sharper gains across the broader end of the markets. The mid-cap index is up in excess of 1%. It was underperforming the index in the first half of the session, but picked up pace and has managed to outperform. In fact, the breadth of the market also looking fairly strong, almost 5:2. That's the NSE advance decline ratio. 2,000 stocks advancing to 860 stocks declining. So that's also a departure from what was really happening in the last few sessions. We saw a pressure in the broader end of the markets on a daily basis. We used to see the breadth, skewed in favor of declines. But today, turning out to be a good one, and hopefully we will end around that 26,000 mark as well. In terms of the sectors then, what's taking the lead today, of course, real estate, that's been beaten down, making a very strong comeback. In fact, the realty index is the top sectoral mover. If you look at some of the other sectors, what's doing well aside of the real estate pack is autos, energy, pharma. Of course, in lots of sectors turning around today. FMCG as well in the green. PSU banks, had a down day yesterday. Once again, it's back in the green. So gains are fairly broad-based, but metal is the only pocket that's trading in the red as we speak. Even if you look at the week-to-date picture for the Nifty, mild losses, somewhere around 0.3% or so. Thanks to today's move, we managed to curtail some of those losses. PSU banks are the biggest gainers for the week. 1.5% gain on the index. IT closed second yesterday. It saw buying interest today as well. There was, some bit of follow-through buying coming in IT. But, gains have kind of fizzled out. Although the Nifty IT index is in the green, but it's almost at the bottom of the heap. FMCG is the other one that has gained on a week-to-date basis. But what's not done well on a weekly basis are the likes of autos, banks even banks. Bank index is down somewhere around 0.5% for the week. Media is, I think, the biggest laggard for the week, down 1% or so. Quickly take a look at some of the individual movers then. Shriram Finance, that's the top Nifty mover, and of course, it deserves mention given the fact that it has sealed its deal with Japan's MUFG. In fact, Mitsubishi has agreed to invest 39,618 crore rupees for a 20% stake in the company. Of course, the company's board had met today to mull fundraise, and also there were expectations that this deal will come through, and that's exactly what has happened. Another transaction, MUFG will subscribe to 47.1 crore shares at a little over 840 rupees per share. That's at about a 7% discount to yesterday's close price, and the deal is extremely important given the fact that it's the largest FDI deal in the financial space. A huge deal that will significantly strengthen the NBFC's balance sheet, sharpen its valuation appeal as well. Just want to point out that Chola Finance, on the other hand, has taken a sharp knock. There are concerns about valuations there because if you look at Shriram Finance, it's trading at somewhere around 2.2 times book, but Chola is at 4 times. I think that's one concern that's kicked in for Chola Finance, which is why it is sulking in trade. But let's bring on board our first guest for today then. Joining me is Vikas Gupta, CEO and Chief Investment Strategist at Omniscience Capital. Vikas, lovely chatting with you this afternoon, and I want to start by touching upon this largest FDI deal that's been announced today. MUFG buying 20% stake in Shriram Finance. Of course, Shriram Finance is India's second largest NBFC after Bajaj Finance. Just want to understand what's your reading of the deal. The pricing, of course, is at a 20% premium. What are you reading into it? How would it benefit Shriram Finance? Your first take.
So overall, if you put the banking and this sector together, then we are certainly seeing a large amount of interest from foreign banks and financial companies to enter India, right? So this is like a market entry strategy for them.
Hmm.
And we've seen those things in some of the private banks, and everyone cannot get into a bank. It is a little bit more difficult. And this is like a proxy. So the interest to get into India for the long term is very, very visible here. And I would say that is the most important takeaway from this. Uh, from valuation perspective, it is fine. It is reasonable. And as the things heat up, there could be more premiums for other companies. But it's a good thing for Shriram Finance.
Okay, just want to understand, according to you, what or how will life change for Shriram Finance after this deal? What will they do with all the growth capital? Where do you think they have the potential to step up? They're already strong in CV, MSME, etc. Will they increase exposure to other sectors as well? How are you looking at that end of it?
Yeah, I think they don't really have a choice. They will have to expand out of the commercial vehicles because I don't think the kind of growth
Hmm.
which they need to do after getting such large amount of capital that commercial vehicles will be able to absorb. So there is no question that they will have to diversify and probably give more competition to Bajaj Finance probably.
Okay, give more competition to Bajaj Finance. If you look at Shriram Finance, the capital adequacy ratio is already strong at 20%. So, how does this really bode for the cost of funds, return on asset, and is the stage set for a massive re-rating of the stock as well after this deal?
Yeah, so like you just mentioned that there is adequate capital, so they didn't need capital just for growth, right? But however, now they do have a lot of capital,
Hmm.
and there will be pressure on the board to actually on the management to actually now show the growth happening on the ground, and the strategy which they have probably planned while doing the fundraise, they will have to now start sharing it and executing on the ground. And if that happens, so next few quarters, let's say next couple of quarters, they are able to articulate what other areas they are going to diversify into, and show that they're able to win in those markets. If that is visible, then there will be a huge
Hmm.
re-rating probably because the growth
Okay,
dimensions
all
could
right. That's
change
about
significantly.
okay. All right. Okay. So aside of this, the other big announcement today was the Bank of Japan rate hike. Of course, they've hiked rates to 0.75%, hiked rate by 25 basis points, and the interest rates in Japan are now at the highest in over 3 decades. What do you think this means for global fund flows and especially India, which has seen such a large outflow, $18 billion withdrawn this year? How do things change from here on? Do you think more capital will flow back into Japan, given the kind of interest rates they're offering now?
Not really. I don't think so. In fact, there is expectation of even further increases because the CPI in Japan is around
Hmm.
3% and you are still at 0.75. So you are actually below the inflation. Uh, Hopefully the inflation comes down to 2% and still you are below the inflation. So the Japanese interest rates have a upward bias. So they will try to
Hmm.
till the inflation comes down, which doesn't seem likely without further increases in interest rates. So we have to live with the fact that Japanese interest rates are probably going to be here or even higher. And under those circumstances, I mean, the
Hmm.
old method of raising money from Japan and allocating everywhere else, that becomes a little bit weaker. So
Hmm.
that's the negative
Okay.
side.
All right. All right. Of course, flows have been missing from the Indian markets. Last couple of sessions, we did see some amount of buying, but I don't know how sustainable that is. But what's your sense? Do you think after the kind of reforms that have been undertaken by the government here, and the kind of earnings that we saw in the second quarter, and a lot of experts, of course, the general consensus is that earnings will only improve here on, and third quarter, fourth quarter onwards, for FY26 at least, we will see double-digit earnings growth. In that sense, do you expect foreigners to come back anytime soon, perhaps? Start of for 2026, what's your sense? And we also are waiting for details on the India-US trade deal. No sign of it yet. How much of an impact will that have on FII flows, on getting FIIs back into India as well?
Yes, see, we cannot say exactly which month or quarter they will start coming back. Definitely the trade deal, if it's a good trade deal for India, then it should it should be one of the triggers for them to come back. But overall, they have no option in the long run to come back to India. So whether it's initially Jan 2026, or is it first half of FY27, that is all difficult to predict at this stage. But they have no option. Indian GDP projections are in 7% real GDP growth rates, right? Across the board, 6.5 to 7 point something is the range. No other major economy is growing at these kind of paces. And the domestic, everything is absolutely highly unique compared to any other similar size market. So they cannot exit.
Okay, of course, in the long run, FIs will come back but it's the near term that we are really worried about, because long term story for India, as everyone says, is pretty strong. But what really matters is what's really happening in the near to medium term, right? So perhaps, of course, we'll see how things really pan out in terms of the India-US trade deal. Details are still awaited, and of course, how earnings also pan out. And of course, we also have the budget in February as well. But let's talk about sectors then. Accenture, reported numbers yesterday. First, its numbers beat expectations. Growth was steady. Deal bookings have been strong as well. But the IT firm has maintained its full-year guidance. What's the read-through for Indian IT? Do you think, in terms of discretionary demand, the environment is pretty much the same, or do you think there has been some kind of improvement? How should one read into it? And in terms of Indian IT earnings visibility, what are your thoughts?
So, see, around, I think 1.5 years still, there is going to be a lag till we start seeing double-digit kind of growth rates for the IT firms. So the order bookings, interest in AI, all those things which is supposed to drive the growth, their indicators are good, but it's still a tiny fraction of the total revenues, and that's why it's not showing up in high growth in the total revenues. And the discretionary spend would still take about, I think, 1.5 years at least before we start seeing double-digit kind of growth and AI driving the Indian IT services. So that's the thing which could take it to a long-term double-digit, but still not near-term.
Okay, yeah, of course not near term, but where are you on the mid cap versus large cap IT thesis? Would you tilt more towards mid caps in terms of growth? Are they better poised than the larger caps right now?
No, absolutely. Large caps are because of the large income revenues already, they are not able to show the growth rate translating. Mid caps are already inching to double digit or higher numbers, right? So definitely on a growth front, if you are evaluating, we would tilt towards the mids.
Okay, tilt towards the mids when it comes to the IT universe. What are you really doing in these markets right now? Of course, we've hit record high some time ago on the index, but since then we've seen a fair bit of correction as well, and broad end of the markets haven't really fired up. There is pain. Portfolios have suffered. You've got some stocks that have shaved off 30-40% from their all-time highs. So even though the benchmark indices hit record highs, the mood was pretty somber. And now, of course, so that this whole phase of correction has kicked in. How are you approaching the market? In what ways have you, rejigged portfolios? Give us a sense of what you are doing and how you're navigating this bout of volatility in the market.
Yeah, so see what we have in our portfolio, we are overweight on the banks, we are overweight on financials, we are overweight on power, utilities. So these are the kind of companies, as well as there is a mix of some infrastructure related companies which are executing infrastructure projects where there is very long-term visibility in terms of order book, etc. So these are the kind of things, and you have to live with the volatility. But in many of these cases, dividend payouts are also coming in, these companies are significantly undervalued. So, I mean, the market being at 22 odd PE, our portfolio is at around 11, 12, but with the growth expectations of 14 to 15% forecasted growth rate. So, it's kind of
Okay.
very, very sweet spot if you enter at such a point from a long-term perspective. You know?
Okay, interesting, thing to note is that, after COVID, people, the average return people got used to was in excess of 20%, right? So now when I meet people, they say, okay, this mutual fund is just giving me a 15% return. Is it good enough, or should I switch to something else? That's the kind of mindset that's been around, especially given the fact that we've seen such a strong rally play out post COVID, right? So my question is, what is a reasonable return expectation for 2026? Because when I heard that 15% return, I was like, okay, it's good given the kind of year that we've had, but the expectations are actually, they have had a makeover, so to say, post COVID. So for 2026, what is a good return expectation that one should work with?
Yeah, so we just did some estimates and will be coming out with the forecast for 26 report. But see, given that you are at 25 PE, roughly 24 or 25 P in the market, and depending on which index you use, but the growth rates are, even if they are 12%, then it's kind of fairly priced. And if it's let's say slightly lower at 10 or 11%, then there could be a little bit of re-rating if you talk about de-rating, rather, if you talk about fair valuation. So that gives you somewhere around, let's say, 8% to 12% kind of a range, you know, for the year on a conservative basis. Now, of course, if some earnings growth kick out way beyond that, or the outlook is significantly higher at 15% for FY27, if that kind of a change happens, then you might see a more than 12% return.
Okay. Okay, I'm sure a lot of people will be disappointed. I just saw the disappointment on the gentleman's face when he said that, oh, I just got a 15% return from this mutual fund. Any which ways. So moving on, rupee has been, has had a very big fall. Of course, we've had the rupee pulling back as well to 90 levels, but 91 is here and is a reality. And a lot of experts that we spoke to said that 90 to 92 would be the range on the rupee, at least for the next couple of quarters. If that's the case, how should one really make use of this advantage, especially in terms of export oriented themes? We spoke about IT, yes, but any other pockets that one should look at to play this whole rupee weakness theme that's emerged?
Well, so pharma and IT are the obvious ones, the large ones, but there are some small caps which export, auto components, or they do various other textile, etc., but which are facing tariffs. But of course, the rupee depreciation reduces the impact of tariffs a little bit. And so you could play the traditional sectors which are impacted by tariffs, because this is kind of shaving the impact of that, right?
Okay, got your point. Vikas, you mentioned that you guys are bullish on banks. Just want to understand, within the large cap private names, anything, is there anything you guys like? Because there are concerns about margins, especially since Axis Bank has flagged off that their margins would be bottoming out later than what they had expected, either last quarter of this financial year or first quarter of next financial year. So other banks, in fact, we are yet to hear about their margin trajectory going forward as well. But would you be cautious on private banks, at least from a tactical perspective?
No, I think like we would rather use this as an opportunity to build up and get overweight on the banks because once the margin concerns are gone,
Okay.
then we know what will happen to the banks, right? So the time to get into the banks is during the period when, correctly or incorrectly, the rest of the world is saying, I'll react to this, and oh my God, for next couple of quarters, the margins are low. What matters is the long-term margins, right? And if the long-term margins, there is no
Yeah.
reason to worry about, then you value it on the normalized margins rather than near term. And so for us, this is a good thing,
All right. Okay.
Yeah. And
Okay. So
just
use
to
this as an
clarify,
opportunity to
can I
build your
put in one
portfolio
more
and
point?
accumulate. Sure, sure, sure.
Uh,
Please go ahead.
Yeah, so the point about the expected returns. So one more data point I wanted to share that while what we discussed was for the passive or index investor, there is, let's say, around 30% to 35% stocks or part of the market, whether you'd say large, mid, or small, which is significantly undervalued. Okay, so out of the top 500, around 170 stocks are undervalued. And so for an intelligent, sophisticated, active fund manager, the returns would be significantly different, even better than your person who was asking about 15% returns. So it probably could be even more than that for a good
Yeah.
actively managed strategy.
A
So
good actively managed fund, you're saying. Okay, okay, got your point.
absolutely.
All right.
Yeah.
Let's also talk about the consumption. Let's also talk about the consumption space. Yesterday Jeffries came out with a note on Hero MotoCorp. They've downgraded the stock, saying that the GST-led demand boost may be fading. Would you concur with that? Of course, they had some data points to cite. They said that the market share for Hero MotoCorp has come down in December compared to what it had in October and November post the GST cuts. Would you agree with this thesis that the GST-led demand boost will fade, or do you think GST benefits will accrue in the longer term as well? So it's too premature to say actually that the GST-led demand booster may be fading away. What is your take on this?
Yeah. So I don't think the GST demand trigger is over, right? I mean, it's a longer term thing and it is going to sustain. There might be other concerns on Hero, that's a different issue. But overall, GST-led trigger is definitely going to help the auto sector as a whole. But the forecast of like double-digit growth rate for auto sector, how long that will sustain is more of a concern. So next couple of years, it looks like that, but the longer term probably is slightly lower growth rates, right?
Okay, all right. But what do you like within the auto space? Would you tilt more towards two-wheelers, four-wheelers? CV cycle has also started picking up. So would you play that, or would you stick to the passenger vehicle names, or would you prefer the two-wheeler space?
Yeah, so we have to be careful. I mean, what you have to look for is the growth rate is very strong in the passenger vehicles, right? Four-wheelers. The only concern is the valuations are also fully accounting for that. So we would rather look at the, suppliers and if there is any mispricing because all the well-known names seem to be fairly priced. So if you're happy with the fair price plus a little bit of growth, then you could pick any of those.
Okay, all right, got your point. Lastly, Vikas, for 2026 in particular, if I were to ask you for two to three themes in a pecking order, if you can, list it out for us.
So our number one is PSU banks, number two is private banks, number three is power sector. So these are and number four, if you want, is a lot
Okay,
of things in the industrials.
okay, but none of the consumer tech names feature on that list.
Consumption, no, no, not really.
Okay, no, I was talking about
Valuations
all
don't
those new
provide.
age stocks.
Okay,
Okay,
yeah. So
okay,
new age
got it, got
stocks
it.
is good. The growth rates are fine, but valuations are concern again there. So it's probably fully valued as with all the known data we know.
All right. Okay, got your point. Okay, Vikas, with that, would like to thank you for taking out time and sharing your perspective with us. Always a pleasure, and I look forward to our next conversation as well. And hopefully, it'll happen this year itself. So I'm not wishing you Happy New Year just yet.
Okay. So pleasure being
Thanks a
here.
lot.
Thank you.